China's manufacturing investment in ASEAN soared. Since the onset of the US-China trade war, ASEAN has become the primary destination for companies looking to shift supply chains away from China. However, the region's recent success is now under threat as significant reciprocal tariffs on ASEAN economies, temporarily delayed by 90 days, loom large. Current negotiations aim to curb ASEAN's growing trade surplus with the US and limit the contribution of Chinese firms and value-added inputs in ASEAN exports to America. However, even with tariffs, don't underestimate the ASEAN region's economic capabilities. It is one of the fastest-growing areas in the world in terms of GDP and population. It has a massive 690 million people, twice that of the US, a nominal GDP of $4.3 trillion, and a GDP PPP of $13 trillion. Drawing on insights from China Cross-Border Monitor databases, this note examines the evolving role of Chinese investors in ASEAN's manufacturing sector over the past decade and looks ahead. Key findings include: ASEAN has risen to become the top destination for Chinese manufacturing FDI by the number of announced deals, largely driven by rising geopolitical tensions, regulatory hurdles, and tariff pressures. Although the United States and the European Union have also expanded investment in the region, the surge in Chinese foreign direct investment has really positioned China among the leading foreign investors. As a result, any disruption to Chinese-owned supply chains would also ripple through foreign-owned operations. Chinese companies have shown remarkable agility in adjusting their presence in ASEAN in response to regulatory and geopolitical shifts. This dynamic could provoke a so-called whack-a-mole response, particularly from the United States. Tariffs exceeding 30% would significantly damage ASEAN's diversification momentum and undermine China's foreign direct investment presence in the region. ASEAN negotiators could help cushion the impact by pushing for a wide tariff gap between ASEAN and China, while securing continued access to Chinese inputs for several more years. Global manufacturing investment into ASEAN's 10 member countries has surged since 2017. Official ASEAN statistics show that from 2013 to 2017, annual FDI averaged around $30 billion. In 2018, it jumped to $60.8 billion. Aside from the sharp drop in 2020 due to COVID-19 restrictions, annual FDI from 2018 to 2022 remained strong, averaging $58 billion. According to FDI Markets, the momentum continued into 2023, with investment rising another 61% compared to 2022. The 2018 spike in FDI was largely triggered by the first US-China trade war and strong economic growth across major ASEAN economies. In contrast, greenfield investment in China began to decline rapidly after 2017. COVID-19-related supply chain disruptions, alongside ongoing US-China tensions and de-risking policies under the Biden administration, have helped sustain elevated investment levels in ASEAN as firms look to diversify away from China. Chinese companies have been a major driver of this trend, although estimates of their role vary depending on the data source. Official ASEAN figures show that US firms dominated manufacturing investment between 2018 and 2022, contributing 25%, followed by Japan, 11%, and the EU, 10%. China's share, though growing since 2018, stood at around 8%. However, FDI Markets data suggests China's share could be closer to 25%. In reality, Chinese contributions are likely even higher. ASEAN's official statistics often miss investments channeled through offshore structures and holding companies, practices especially common for Chinese investors using Hong Kong as an intermediary. Additionally, flows through Singapore are also undercounted. Host country data highlights these patterns. For example, Vietnam's 2023 figures show Singapore and Hong Kong among its top 3 sources of FDI, together representing 31% of inflows, while only 12% was officially attributed to China. The Rhodium Group's CBM database, which tracks verified investment deals, offers a detailed view of Chinese manufacturing FDI in ASEAN. By focusing on announced transactions, the database captures shifts in investor sentiment in real time, avoiding the timing lags and geographic misclassifications often found in official statistics. It also enables a deeper analysis across countries, sectors, and investment types, covering both M&A and greenfield projects, providing a clearer picture of Chinese capital flows into the region. CBM data shows that Chinese greenfield manufacturing (FDI) in ASEAN rose steadily between 2010 and 2017, supported by strong GDP growth in ASEAN economies and rising production costs in China. Geographic and cultural proximity, trade integration under the ASEAN-China Free Trade Area, and ASEAN's strong manufacturing base likely influenced Chinese firms' choices. In 2018, however, Chinese manufacturing FDI into ASEAN nearly doubled year-on-year, likely triggered by the first wave of U.S. tariffs on Chinese exports. From 2018 to 2021, investment levels remained about 3 times higher than the 2014-2017 average. After China lifted its zero-COVID policies and reopened its borders in 2022, another surge followed. Chinese manufacturing FDI into ASEAN has averaged $10 billion annually over the past 3 years, compared to just $2.7 billion annually in the previous 5. Manufacturing has increasingly dominated Chinese investment in the region, accounting for more than half of all Chinese FDI in ASEAN by 2024. ASEAN's share of China's global FDI transactions has also grown, averaging 45% over the past 3 years. 4 countries have consistently attracted the majority of this investment: Indonesia and Vietnam, together capturing about 56% of total value from 2018 to 2024, followed by Thailand, 18%, and Malaysia, 14%. Recently, Indonesia has pulled further ahead, accounting for 30% of total Chinese FDI value over the past 3 years, largely due to major capital-intensive projects in the electric vehicle sector. However, smaller and mid-sized investments remain concentrated in Thailand, Vietnam, and Malaysia, which together made up 77% of the transaction count during the same period. Some countries have seen little manufacturing FDI from China. Singapore attracted some projects, particularly in high-tech sectors like pharmaceuticals and semiconductors, but remains primarily a hub for M&A activity, business services, and real estate investment. The Philippines and Brunei also attracted limited Chinese manufacturing investment, focusing more on energy and raw materials. Meanwhile, Myanmar, Laos, and Cambodia drew smaller investment values due to their limited market size, though Cambodia has doubled its number of major Chinese manufacturing deals over the past 3 years. In terms of sectors, 4 industries accounted for more than 86% of Chinese FDI value into ASEAN over the past 7 years. Automotive, 45%, ICT and Electronics, 15%, renewable energy equipment, 15%, and consumer goods, 9%. These sectors also dominated the number of transactions, though with a heavier presence of capital-light sectors like ICT and Electronics, 22%, and consumer goods, 19%. A closer look at these industries reveals the underlying drivers of China's growing manufacturing presence in ASEAN. Chinese consumer goods manufacturing, particularly in textiles, apparel, and furniture, was among the first sectors to move offshore, as rising domestic wages pushed low-margin production toward more cost-competitive economies. Southeast Asia quickly became the preferred destination, offering a combination of low costs, geographic proximity, and favorable trade access. Since the mid-2010s, Chinese investment in the region's consumer goods sector has accelerated sharply. Vietnam captured nearly 2/3 of all announced Chinese greenfield projects in this space, thanks to its strong integration into global supply chains and preferential trade agreements with both the US and the EU. Initially, Chinese firms' move offshore was driven mainly by rising costs and capacity pressures. However, the start of the US-China trade war marked a turning point, triggering a second, more defensive wave of manufacturing FDI. New US tariffs, up to 25%, on Chinese exports in sectors like household appliances and furniture, prompted Chinese companies to relocate final assembly operations to Southeast Asia, with Vietnam remaining the primary destination, and Cambodia and Indonesia gaining ground. Investment in these industries more than doubled, from an annual average of $240 million between 2014 and 2017 to $560 million from 2018 to 2021. While much of this investment was export-focused, some targeted growing domestic consumer markets. Notably, Alibaba's investments in e-commerce platforms like Lazada, Singapore, and Tokopedia, Indonesia, from 2016 reflected this trend. Post-pandemic, the rationale for offshore manufacturing remains strong, but has evolved into a more strategic and long-term approach. investment levels continued to rise, reaching a peak of $935 million in 2024, with a shift toward higher-value product segments. Thailand, for example, has emerged as a key hub for home appliances and consumer durables, supported by better infrastructure and a growing local market. Meanwhile, companies are further diversifying production beyond Vietnam, expanding into lower-cost, labor-intensive economies such as Cambodia. The offshore shift of Chinese electronics manufacturing began in the mid-2010s and accelerated following the onset of the U.S.-China trade war. After 2017, the average annual value of Chinese investment in the sector doubled, and it nearly doubled again in the post-COVID era, especially from 2023 onward. While electronics initially benefited from tariff exemptions during the first phase of the U.S.-China trade war, major Western tech companies began reducing their dependence on China, seeking both to access new growth markets and to protect themselves from rising competition within China. Chinese suppliers followed their customers abroad to stay integrated within global supply chains. In semiconductors, Chinese firms like J-Set, Tongfu Microelectronics, and Yangzhou Electronics established facilities in Southeast Asia, providing outsourced assembly and testing services for Western clients. Malaysia emerged as a major hub, capturing 67% of regional semiconductor investment and hosting global players like Micron and Intel, with Chinese suppliers clustering nearby to support them. In consumer electronics, Vietnam became the dominant production base, attracting 85% of Chinese investment in the sector between 2018 and 2024. Key Chinese IT equipment suppliers for brands such as Apple, Samsung, and LG, including BOE, Gertech, and Luxshare, set up operations during the early stages of the trade war and expanded further in 2023 and 2024. Following the pandemic, Chinese investment in intermediary components, particularly printed circuit boards, grew rapidly to meet surging demand across consumer electronics, electric vehicles, and semiconductor industries. By 2024, these intermediary products accounted for 72% of new Chinese investments in the ICT and electronics sector. Thailand has recently emerged as a key destination for this new wave of investment, followed closely by Malaysia and Vietnam, as Chinese firms position themselves to supply both local ASEAN manufacturers and multinational corporations expanding their presence in the region. Chinese FDI in renewable energy equipment across ASEAN is overwhelmingly concentrated in the solar PV sector and its supply chain. Investment trends in this area have been closely tied to shifts in global trade policy. Chinese firms began expanding abroad in the mid-2010s, largely in response to trade defense actions in the US 2011 and the EU 2012-2013 that imposed heavy duties on Chinese-made solar panels. During the early stages of this shift, Vietnam became the top destination, drawing about half of Chinese investment value almost every year since 2016 and a third of the project count. Malaysia, Cambodia, and Thailand also emerged as key hubs, offering geographic proximity and low-cost skilled labor to assemble Chinese components into near-complete solar PV products for re-export. By Q2 2023, these four countries accounted for 80% of U.S. solar PV imports. Chinese investment in the region's solar sector surged in 2020, likely triggered by renewed U.S. regulatory action. In 2022, U.S. authorities determined that some panels made in Cambodia, Malaysia, Thailand, and Vietnam were circumventing existing anti-dumping and countervailing duties. Although the Biden administration temporarily suspended tariff collections to ease solar panel price inflation, Chinese firms appeared to anticipate that duties would eventually resume, which they did in November 2024. In response, Chinese companies adapted in three key ways. First, they increased local production of inputs like silicon wafers and module covers in Cambodia, Malaysia, and Vietnam. Second, they shifted investments and production from higher-risk jurisdictions like Thailand to countries with more favorable prospects, notably Vietnam. In 2023, Trina Solar and JA Solar Technologies announced plans to invest up to $1 billion each in Vietnam to expand manufacturing. Third, they diversified production into Indonesia and Laos to minimize exposure to anti-circumvention penalties starting in 2022. This strategic adjustment led to a spike in Chinese FDI in Indonesia and Laos throughout 2022 and 2023, especially from smaller firms, along with a wave of factory closures and scaling down operations in Vietnam in 2024. Meanwhile, mid-sized Chinese companies with greater financial resources began investing directly in the U.S. from 2022, aiming to bypass tariffs and leverage incentives from the Inflation Reduction Act. The sharp decline in Chinese solar-related FDI in ASEAN observed in 2024 likely reflects both mounting challenges for Chinese firms domestically and the anticipated announcement of new U.S. tariffs. The automotive sector has long been a major focus for Chinese FDI in ASEAN, particularly in terms of transaction count, but since 2021, the value of these investments has surged as well. Most of this activity has involved greenfield projects, with a few notable exceptions like Geely's 2017 acquisition of a 49.9% stake in Malaysia's Proton. Chinese investment has spanned much of the automotive supply chain. Thanks to strong manufacturing capabilities and available skills, Thailand, Vietnam, and Cambodia have attracted numerous auto parts plants, including those producing electronic components like printed circuit boards, PCBs. Vehicle assembly operations, meanwhile, have traditionally been concentrated in larger markets such as Indonesia, Thailand, the Philippines, and Vietnam, often led by state-owned enterprises like SAIC and Photon. Since the 2020s, a wave of electric vehicle manufacturing projects has been announced, especially in Thailand and Indonesia, with Vietnam seeing more modest activity. Private Chinese companies like BYD, Chery, and Geely have been at the forefront of these efforts. The region has also seen a boom in battery and battery materials manufacturing projects, particularly in Indonesia, Malaysia, and Thailand. Indonesia's strict export policies on key raw materials, especially nickel, essential for EV batteries, have spurred major investments and led to the creation of an increasingly integrated supply chain covering raw material processing, component manufacturing, and battery production. Between 2022 and 2023, nearly half of all Chinese automotive investment in ASEAN was directed into Indonesia alone. Given the localized nature of the automotive industry, many of these investments are likely aimed at serving rapidly growing domestic markets, with Indonesia, Thailand, and Vietnam together home to over 450 million people, as well as nearby export markets like Australia. However, some investments are clearly targeting global exports. For example, SAIC, facing higher EU tariffs on EVs, has openly discussed using its Thai plant to bypass trade barriers. The growing scale of individual project announcements, including multi-billion-dollar plants from KTL, BYD, and Chery, also hints at an emerging strategy to position ASEAN as a potential export base. The introduction of U.S. tariffs on Chinese goods in 2017 was a key catalyst behind the surge in Chinese manufacturing investment into ASEAN. With tariffs rising even higher under President Trump's 2025 administration, reaching an additional 145% over early January levels by mid-April, the pressure on Chinese firms to diversify production sites has only intensified. Although selective exemptions, mainly for electronics, have since been announced, the overall tariff burden on China is expected to stay high. Going forward, three main factors will shape the momentum of Chinese FDI into ASEAN. First, the tariff gap between China and ASEAN will be critical. If U.S. tariffs on Chinese goods remain much higher than those on ASEAN-made products, Chinese companies will continue to shift operations into the region. ASEAN offers an attractive mix of skilled labor, resource availability, strong trade integration with China, and in some cases, favorable political alignment. However, if U.S. trade negotiations with Vietnam, Malaysia, and Thailand stall and reciprocal tariffs are not lowered, or if tariffs on China are significantly reduced after new rounds of talks, Chinese firms could be incentivized to bring production back to the mainland for U.S. and global markets. Second, increasing U.S. scrutiny of China's role in ASEAN supply chains could complicate matters. Washington is paying closer attention to practices like transshipment and the high Chinese content embedded in ASEAN exports to the U.S. If U.S. authorities push ASEAN countries to reduce Chinese input levels and supply chain linkages, it could undermine ASEAN's position as a preferred diversification hub. Chinese firms and inputs have been far more central to ASEAN's export success compared to other connector regions like Mexico. Recent signs point toward tightening controls. During a meeting with Vietnam's leadership, U.S. Trade Representative Jameson Greer emphasized the importance of curbing trade fraud, origin mislabeling, and illicit transshipment. Reports indicate Vietnam is considering stricter enforcement measures to secure better trade terms with the U.S. A critical unknown is whether these controls would extend to limiting Chinese content in exports destined for America. Third, China's own economic performance will influence outbound FDI trends. The sharp decline in Chinese solar sector investment into ASEAN in 2024 appears linked to broader weaknesses in the sector at home. Similar vulnerabilities in China's automotive or consumer goods industries could dampen future outbound investment. Moreover, as China grapples with sluggish growth and rising unemployment, authorities may move to keep more manufacturing jobs and investment within the country. Beijing has already tightened controls on outbound FDI, especially in sectors tied to national security, and these measures could soon broaden to include restrictions aimed at preserving domestic industrial capacity and employment. If you enjoyed this video, then please like, comment, and subscribe. Thanks for watching.